Hey, Greg Herlean here and Carson Herlean with Generational Gains. We're excited, really excited about today's episode.
Yep.
It actually came about because we had, after our last couple episodes, some people give us some feedback on a couple of things they'd like to hear. They want to hear some real, some more specifics about deeper topics.
Yeah.
And today's topic is really, I'm excited because Carson's probably going to be doing most of the talking. It's a topic that's near and dear to his heart. He talks about every day. And I want him to break it down for you and I as he kind of explains it. So this topic in this episode is called infinite banking. And I know you can Google it. In fact, there's lots of things all online. And I think some people think they know this subject. I thought I knew this subject.
Yeah.
And I'm gonna ask a couple questions, but kind of turn it over to Carson. But before I do so, I want to share that infinite banking, there is a very specific way of doing it. And the reason why I got back into wanting to know more about it is because this guy at the age of 20 came back from his mission, and we're at the dinner table, and he said, "Hey, Dad, you remember that policy you have? Are you using it the way you're supposed to be using it? I had this policy and not been using it at all how I was supposed to be using it." And he re-educated me at the dinner table. And so today I want you to explain, can you just break it down in a simple format?
Yeah.
What is infinite banking in general, and how does it work?
That's a big question. A lot of people are teaching this concept right now. I think infinite banking is kind of like a buzzword in the business industry. I feel like people are bringing it up and wanting to do this, learn about it. And there's a lot of momentum with this concept right now, which is pretty cool. But this concept has been around for over 200 years. This has been around for a long time. It is something that a lot of the wealthy people did back in the day, like the Rockefellers, the Rothschilds. Actually, Walt Disney started Disney with this system, with this strategy. So this has been around for a long time. It is something that I teach every day, and you do and have been doing for a while. So to kind of start with it, I like to start with kind of just an idea, a concept, and this idea in general. So we're taught our whole lives where to store money, where we should put money. We're told once you get out of college, when you get that first paycheck, go give it to the bank. And then once the bank has those dollars, what do they do with it? Right? They're lending that money out to other people. They're earning interest off of your money. And I know there is some government guidelines where you can access those funds, and you can, if the bank were to go bankrupt, you can take it out. But a lot of the time it's difficult to go and pull all your funds out of the bank because they have it leveraged. They're making your money work for them, which is the idea. And after you get that bank set up and you deposit your first paycheck, you typically run most of your life through this bank. You pull funds out to pay your expenses, your bills, your debts, and maybe save it up in your bank for one day to buy a home, make an investment. But we're taught to store and keep our money, our wealth, in a bank account.
Yep, that's totally true.
It's the basic idea. And so what infinite banking is just changing where you do that, changing how you do that to make it a little more efficient and help you make more money long-term and build a legacy for your family, which is how those families like the Rothschilds and the Rockefellers were so wealthy for generations. It's because this system. It's because what they did to really build their family's wealth and not just today's wealth. Does that make sense?
Yes.
So
first, just to break it down, banking, the traditional banking, people put their money with the bank. The bank has your money. They're leveraging it, making interest on it, and you pay your bills from it, etc. And you're saying that's one of the problems. So what should I be doing if I don't want to be using my money at a traditional bank?
Yeah. That's a good question. So there's a difference between, well, I won't even get that deep yet. So what we do is we're storing funds in a different place. This place, I'll explain to you in a second, but this place, I'll just tell you a few attributes that this vehicle has for your money. There is guaranteed interest rate that your money is growing at, which you don't have in a bank account. That money that you grow is tax-free. It doesn't happen in your bank account. When you're given 0.1% on your savings in your bank, you're taxed on that. And this vehicle as well has the ability for you to use the funds while it is still earning interest. That's the biggest piece. And the last attribute of this strategy, of this vehicle, is that it has a payout or a death benefit to your family.
All right, well, let's not hop around, because let's just tell them what this is then.
Yeah.
So this vehicle is a life insurance policy.
It is a specially designed whole life insurance policy.
So whole life, specific
whole life.
to whole life, not universal life, not IUL, not tied
term.
to the stock market, not term, but whole life. So
Correct.
So just real quick, when you hear the word insurance, that's probably one of the dirty words out there.
Yep.
And I kind of feel like for good reason, because most insurance is not made for doing what you're doing. And let me preface also, Carson, since he's been 20 years old, it's only been about a year now, he talks about this and helps people set up these, I call them money accounts, really, using insurance policies every single day. Literally, you're setting up, I don't know, 100 a month? I mean, a lot, every single month.
Yeah.
And so tell us more about this insurance policy.
Yeah.
Let's not skirt around it. Let's just talk about what this insurance policy is, because it is not meant for death benefit.
Yeah.
That's just one of the benefits.
Yeah,
so
I think a lot of people are confused with this concept because they think infinite banking is life insurance, or infinite banking is an investment, or it's a payment or an expense you have. And it's really none of those things, but it's all of those things. There's a lot of life insurance products out there, and they're all great for different reasons. There's the term insurance, which is a small payment for a death benefit. There's other types of insurance policies that give you some sort of living benefit, it's called, where you have this death benefit, this amount your family gets if you were to graduate or pass away. And that's the purpose of most life insurance, is to have that protection and money for your family if something were to happen to you. But there are policies that you can set up that give you a living benefit, meaning you have access to your death benefit now. So you have the death benefit, but you also can access it while you're still alive using it. So it becomes a vehicle that you're funding money into. You're getting those benefits I kind of mentioned, but you can still use it, and you're using your future death benefit. You're using or taking money against your future self. Most of the time, when you're getting a life insurance policy, you can't do that.
So give me an example. So give me an example of so let's just say because a lot of people ask me, Greg, I love investing in real estate, but the problem is I don't have a lot of money. I'm starting with a little bit of money.
Yeah.
Or it's all in my retirement account, and so I don't have a lot of money. You're talking about, I know we're gonna get to this later, but an individual that only has $300 or $400 or $500 a month of money, rather than putting it into a bank account, they put it into a whole life insurance policy.
Yep.
Just explain that to me, like how that works for an individual who wants to start with, let's just say $1,000 a month.
Yeah.
So they're putting away $1,000 a month into a life insurance policy.
Well, so this has to work. This only can work for people who have surplus or excess money. If you were living paycheck to paycheck, not a single dollar anywhere else, you probably can't do this quite yet. However, if you are saving just $100 a month, or you have a budget put together where you can save a few $100 a month, it works. Because those dollars you're keeping in the bank. And most of the time when it goes in the bank, you take it out and you use it to go shopping. People spend those extra dollars.
Sure.
So putting it aside, first of all, that's number one, being able to have that discipline to save money, put an amount aside. Then once it's there, it's probably sitting in a bank, maybe a money market account, earning a little bit of interest. We're changing that. We're funding those dollars into this specially designed policy. So in terms of how that actually works is it is going into this policy as premium, as life insurance premium. But normally with life insurance premium, you can't touch it for years. Even if it is a whole life policy where you can use cash value, you have the living benefit, you don't typically have that living benefit for years. So we're structuring this policy to be available now, to be upfront cash value, and cash value is the amount you can take out. It's your money available to use. And so you have this cash value available your whole life, and it grows every single year because you're always earning interest. So you always have more and more funds available to you, and you can take those funds out and utilize it. So let's say you're putting $1,000 a month in this policy. That's how much you save. That's how much you are already doing. Well, we're changing that, right? $1,000 a month will go into this policy. So for those of you on YouTube or anywhere else that's listening to this, if you have a pen and paper in front of you, pull it out. I'll give you kind of this example of how I look at this. Once these dollars go in the policy, what happens? So I kind of mentioned it, but you can write a little T chart on your paper, and on the left side of the T chart, you can write bank, and on the right side, you can write policy. So to outline the differences, so you see why you would store your funds there instead of in a bank, what you can write under each column is, first, under bank, you can write unprotected, and under policy, protected. So every dollar that goes into this policy, $1,000 a month, right? That is protected against any lawsuits, any judgments, anything. The policy can be in your name or an entity, whatever, but it is protected. If you personally were sued, those dollars in your bank can be taken, whatever happens, liable. Policy, there's protection. So there's a level of safety within every dollar you put in there.
Okay.
The next level is, I kind of mentioned it, but the guaranteed growth. So in your bank, the average growth rate in a bank account right now is 0.06%. And within the insurance companies that can do this, the average guaranteed rate is around 3%. Guaranteed, they typically pay more than that, but that's just the guarantee. Next up is tax-free. Everything in your bank is taxable. Everything in your policy is tax-free. Easy. And then the last two pieces I mentioned, but the death benefit in a policy, and there's no death benefit in the bank account. So if you were to pass away today, those dollars that's sitting in your bank can get taken for, I don't know, whatever happens with your family, your funeral, things like that, expenses with death. I don't know exactly how that all works, but those dollars, that's all you have. In your policy, your family could be given multiple $100,000, multiple $1 million just because you kept your money here instead of in a bank. And then the last piece, which is most important in my opinion, is there's uninterrupted compound interest. Uninterrupted is the main word. Every dollar that goes in the policy that's earning interest, it's never going to stop. If you're earning that 3% guarantee, that is always going to be earning your whole life. If you put $1,000 a month in this policy, $12,000 a year, $12,000 a year is always going to be earning interest for you no matter what. Even if you pull funds out against your death benefit, you're still earning on that $12,000. That's the biggest piece. So now it allows you to be the bank. Your money's somewhere safe, earning interest, completely risk-free. You can still pull those funds out of the policy as a loan against your death benefit. It's your living benefit, and you can use those dollars now. So now you're using the insurance company's money, because when you take that loan, it is the insurance company's general fund you're pulling from. So now you have your money earning interest and their money you're using to go pay your debts off, to go make more investments, to build your wealth in some way. If you need to buy a home or a car, you can do that with this.
All right, so let me just cut you off for a second.
Yeah.
Because I think you explained pretty well the difference between investing, or I shouldn't say investing, putting your money at a bank,
Yep,
or putting your money in a life insurance policy.
Yep.
Now, most people will say, when you ask about life insurance, everyone's like, I got one of those. I've got a life insurance policy.
Yeah.
And let me just reiterate, for probably 15 years of my life, had life insurance. I had term or universal life, and they were specific to death benefit. Mm-hmm. So I want to reiterate one of your points. The purpose of this is more for banking and not for death benefit. Death benefit just happens to be one of the benefits, and that's it.
Yep.
And so for me, what really changed when I understood this infinite banking, and you explained it to me really well, is that instead of trying, most people say, look, I have to either get this much in death benefit. Let's say it's $1 million in death benefit.
Yeah.
Or I could only have $100. So someone with $100 a month is trying to get as much death benefit as possible.
Yeah.
And that's how typical America is with life insurance. They're just trying to max out their death benefit. This is not that.
Yeah.
This is banking, which again, I think most people think they've got life insurance, and you do for death benefit. Yeah. This is not that at all.
Yeah.
Infinite banking is meant for putting up as much money that you can save instead of in a bank, but into a life insurance cash value guaranteed whole life. That's right, I said guaranteed because it's almost one of the only things you can say guaranteed about.
Yeah.
But you're putting up as much money as possible and really getting the least amount of death benefit.
Yep.
So typically, in an example, if I want to pay $1,000 a month, I would probably get a $5 million death benefit. In the example of these whole life policies, I'm putting $1,000 a month in this example and getting maybe $200,000 death benefit.
Yeah.
Death benefit is just one of the benefits of banking using a policy. So
It's a great point.
So let's just break down. Can you break down, like, you own one of these policies?
Yeah.
These infinite banking policies.
Yeah.
How are you using it? What are you using right now?
Yeah. No, that's perfect way to explain this, because you're 100% right, and that's something people forget about, is that they think this is not what it is, and it is just for banking, just storing your funds somewhere different. So for me, I have a few policies now, and what I utilize them for is, first, I fund my extra dollars there, and then right now I don't have any debts, so I'm sending it out to investments. So I'll give you one example. One policy I have, I did $90,000 up front, and I pulled out, I believe it was around 70,000 right away, and I put it in 2 different investments. And so the reason I did that, and I'll give you some numbers behind that. So now I have 90,000 in this policy that is earning interest for me.
Let's say
It's around 5.5%.
5.5%.
The 3% was the guaranteed part.
Okay.
So we're at 5.5% earning at 90,000. I have $2 million worth of a death benefit, and I have protection over that 90K.
Now, hold on. Normally, a 20-year-old who puts $90,000 on a life insurance policy is going to have like a $10 to $20 million death benefit. He's got just a $2 million death benefit. I just want to make that clear. So go ahead.
So those are some of the numbers. I pulled 70 out, and it's in 2 investments. One investment's paying me 1% a month, and the other is a short-term flipper. So it'll be like 3 months. I'll probably make 12 to 15%.
So basically, I want to go slow on this.
Yep.
You put in $90,000. That $90,000 is earning 5.5% annualized.
Yep.
Right? Tax free.
Yep.
And then you pulled out 70, and when you pulled out the 70, the 90 is still making 5.5%.
Correct.
Even though there's only technically 20 there.
Because the kind of how I explained it, that 90 is with the insurance company in their investments. They're building their business now. You are pulling a loan against your policy to take money out.
Got it.
And it is using their money that you are taking out. So your 90 is in their funds, in their investments, and your 70 is their money you have in investment. So your risk is out of the deal too. Their money is in the investment. And so now you have 70 grand in these 2 investments. And as I'm getting these monthly payments back, I'm putting it back into this policy, back into where the 70 grand came out of, which was the cash value.
So you're making 1 to 2% to taking those 2 investments, blending it. You're making 1 to 2% on average per month.
Yep.
So on $70,000, you're making, well, more than that, $700 to $1,000 a month.
Yeah.
Yeah.
So $1,000 a month I'm putting back into this policy.
Got it.
And then when it builds back up to another 25, I'll pull that out for the next investment. And then now I have $1,200 coming in every month from these investments, and I'll continue to put that back in the policy.
So you're just churning your money. You're basically putting money in, taking it out immediately, pretty much within 30 days, redeploying it, earning interest on that loan that you took, and putting that interest back into the policy.
100%.
So it's truly like if you were banking.
Yep.
If you were to put $100,000 in the bank, but then you want to invest in this real estate deal, you would take it out and put it in there and earn interest. The difference is when you do that in an insurance policy, you continue to make interest in the insurance policy, but also you're kind of double dipping, basically making interest on your money that you've borrowed out of the policy. Fair?
100%. That's exactly why we do this.
So the example that I think you can see online that everyone talks about, and I'm not going to dive deep into it unless we want to. In fact, I think you should add at the end of this podcast maybe a little grid or video on this one slide. But the common thing that everyone talks about is buying a car and getting it for free. Now, I thought it was too good to be true. I've now done this on several cars. All right, so the example that everyone talks about, or at least that I think everyone talks about when talking about infinite banking, is getting their car paid for. So what I've done is I've put in a large sum of money every single year, and instead of putting it into my bank, I've put it in this insurance policy, like you. And so now when I buy a vehicle, let's just say I buy a $100,000 vehicle.
Well, what was the last one? Didn't you buy a Didn't you buy the Bronco with it?
I bought the last 3 cars with this insurance policy. So I've bought a Range Rover, a Bronco, and a Tesla, all from my insurance policy. So you can use that as an example, right?
Yeah.
So I had $300,000 of cash value in my insurance policy. So I took out $300,000. Okay. I then paid cash for all 3 vehicles, right? So now I own the cars all free and clear. But if I were to borrow $300,000 and buy those cars
From a bank,
I'd have to pay the bank every single month.
Yeah.
And let's just say that monthly payment was going to be $3,000 or $4,000 a month, right? Call it what's the number?
3 is fine, yeah.
$3,000 a month, okay? So I was going to have to pay $3,000 to a bank.
And call it 6%.
That's right. But instead, that I'm going to spend or send that same $3,000 a month back into my life insurance policy. So I'm going to repay back that loan back into my insurance policy every single month rather than to a bank. And at the end of 5 years, I'm going to have more than $300,000 in my account, and I'll have 3 cars free and clear. Does that make sense? So basically what I'm saying is I borrowed it from myself, my own insurance policy, paid off the cars. Now I have a loan with the insurance company that I have to pay back. So every month I'm making the payments that I would have been paying anyways to a bank, but instead to the insurance policy. And after 5 years, then in my insurance account, my life insurance account, basically, that account will be more than what I paid for those 3 cars. That's the common thing. And you can do that for anything. You can do that for education. You can do that for a house.
And you can even get creative with it and say, okay, I owe 20 grand on credit cards. I have a mortgage. I have a car. All these things most people have. If you just paid those things off with your policy, you're going to earn interest on everything you put in there and get the debts paid off and pay it back yourself what those high interest rate credit cards were.
That's right.
So maybe you don't pull 70 out like I did to go buy an investment or do an investment. Take the 70 out, go pay off 70 grand of credit cards that were 25% interest rates. That's much better than the investment. And now I'm paying back myself what I was paying to the credit card company because I freed up that monthly payment. I freed up what I was paying to other people, and I can pay myself that and build it back up in my policy. And when it builds up to a certain amount again, pay the next debt off or make the next investment.
Okay, so one thing I want to say, because we're going over to, this is one of those podcast episodes that there's a lot of numbers, and this might be foreign. And in fact, I think for most people, I actually think they don't think it's foreign. I think if you're listening to this, you probably think you've heard of it because you have life insurance. This is not that at all. And so I want to preface by saying, if this is a little bit interesting to you, and if you want to see how this works for you, you should definitely click here and learn more. Connect with Carson. He does this for a living for people all over the United States that are looking to set up these policies. And it's much more fun and interesting, in my opinion, to look at your numbers. So I can talk, it's like, oh, great, Greg, you talked about buying whatever, a Bronco with it. I can't put away that much money. That's okay. Carson also has a policy he didn't tell you about that he only puts $1,000 a month away on. So this works for almost anybody. There's very few exceptions, right? You have to be insurable, right? You can't. You got to have some insurability. So you got to be kind of healthy to get this. Not to be totally healthy, but just be able to get an insurance policy. And so I would say if you're interested in learning more, and we're going to go a little bit deeper before we wrap up here. But I want to make sure that you don't get confused or you think that you already know this subject. I wanted to kind of stop us. If you want to learn more about this, DM.
I'll even have a personal phone call or Zoom with you, and we can go over your situation and look at it, because it can work for everyone. Even if you are swamped in debt, I've helped people get out of hundreds of thousands of dollars worth of debt and still, and not by changing anything, not by making more money, not by decreasing their expenses, just by changing where they put their money first, which is the policy, and then back out, and then paying off the debts from there and doing a couple strategies within that system. But this system works for everyone, and it's just changing where you keep your funds and being disciplined about it, and we can help you do that. So even if you want to do this with us, and we'll show you how it works. And if you want to come on our podcast and we can show your numbers and we can give everyone a real life example, that'd be awesome too, if you want to.
Yeah, look, I want to also say in this, because this is different than most other episodes, we're not here to sell anybody. We want to give.
Yeah.
So you might have heard things, and there's other things we're not going to go too deep into, but there's loan expenses. Like, well, this is not something new or naive that Carson knows it probably better than me. Even though I've been doing it longer than you've been doing it, as far as with my own policies.
Yeah.
That being said, our goal is to give you content, give you education, and in this situation, if you want a session or a phone call with Carson and he'll explain your numbers, how this works for you, definitely reach out to him, because looking at your own numbers makes a big difference. And if you might have a lot of questions like, hey, I think I already have this, or what, I already have a life insurance policy. Can I convert it to this kind of insurance policy? The answer is yes. If you just want, just education on this, Carson can help you do that for sure.
100%.
So what things did we not talk about when we're talking about infinite banking still here? So what are some common questions that people ask when this subject comes up that maybe we haven't covered yet?
Yeah, that's a good question.
Is there anything that we haven't covered that comes up often when people want to get into this?
We can talk for a second about qualified funds. So a lot of people look at this and say, okay, well, can I roll over my 401k, or can I put my IRA into a policy? And the answer is yes, but you can't fund your policy from an IRA without paying taxes or penalties possibly. So can you explain real quick what that is? What is non-qualified funds versus qualified funds, and why does that matter with this?
So look, qualified funds are retirement funds. If you have a IRA, simple set, any kind of retirement account or 401k, those accounts don't qualify to transfer into an insurance policy to do this. In fact, I think it is a terrible idea when I hear people pitch, hey, buy this life insurance policy and cash out, pay the taxes and penalties, and here's why. You don't have to do that. You can have your retirement account and also have your banking account. In fact, most people do. If you're listening to this, you probably have a retirement account and you also probably have a bank account. And I think the message here is, when banking, bank with an insurance company. I mean, one thing I think is important that we didn't cover too much, and so let me finish that subject real quick. Qualified funds are retirement. Non-qualified accounts are non-IRA, non-retirement accounts.
Which includes life insurance premiums and dollars there. So
that's right. So why I think one of the coolest things about insurance policies that people don't talk enough about is because look, insurance typically is a dirty word. People don't like talking about it. But everyone has it, and I think that's why people don't like talking about it, because usually it doesn't come to fruition. You pay all this money into any kind of health insurance, car insurance, and people get pissed off.
And you feel sold. And
but this kind of life insurance policy, but let's just talk about life insurance companies. Yeah. These companies that you work with have been around for hundreds, right? I mean, sometimes hundreds of years. But I think what's I think interesting is insurance companies. They're the companies that governments and banks go to borrow money. So if you're wanting to invest your money somewhere to feel safe, wouldn't you rather do it at a Mass Mutual, at a company like that's been around for 100 plus years, who has 1-to-1 ratio, who has tons of cash, who can guarantee your money? I mean, that's another thing. If you have $1 million cash value at an insurance policy, it's guaranteed. Well, I shouldn't say all insurance policies, these type of insurance policies. Not like in a UL indexed account. And so I think that's I think very, in today's banking world, everyone's talking about the banks that are failing and having problems. Insurance companies are one of the safest places to put your money.
And you know what's interesting is we all think banks are the wealthiest companies. More than 50% of Wells Fargo, of Citibank, of Bank of America's balance sheet is whole life policies, is these type of policies. Banks own this. They all do it. Why wouldn't we do it? They're the most wealthy people here.
So look, if you're wanting to learn more, I think this is a great. So is there any great subject to kind of look deeper into? And again, I definitely schedule any kind of time with, or send him messages. Carson will get back to you. I only know what I know because I've been doing this. I had these policies. I put money into them. Wasn't taking them out like a bank, like I should have been doing. And that's when Carson got my attention. So now I kind of move my money using insurance policies to buy and borrow rather than borrow money from a bank. I'm borrowing it from myself, really, from my own insurance policy, and then paying it back. It's super powerful. This is what the rich and wealthy are doing to get richer. They're using these tools that have been around for such a long time. So what else? Is there anything else that you want to share about on this policy? I mean, on this policy? subject?
You hit a little bit on the power and profitability of these insurance companies, but I think my favorite stat I heard recently was during COVID. One of these insurance companies we work with, they were looking at their numbers, and a lot of businesses were going bankrupt at the time, and they were like, okay, well, if every single person that has a policy at our company passes away, and we have to give out every single death benefit to every person we have work with, after they did that, they did the numbers, and they still had left over $1 billion. That's how wealthy these companies are, and that's where your money's at, guaranteed. It's pretty cool.
Well, so another stat I remember when I researched life insurance companies a long time ago. Again, this is a subject that I think most people get bored with, but I kind of get excited about.
It's cool. Yeah, it's different.
Is why are these companies so rich? And one stat that I remember in this is just think about if you've had a life insurance policy, because most people buy term or other policies or even whole life policies. But what they end up doing is doing it for the death benefit. And they're only out to find the best deal for the life insurance premium. So why they're so successful, just think about it, is the average amount of people that keep their life insurance policy, the average length of the policy is 4, I think, to 5 years. Is that right?
Yeah.
And so basically what that means is everyone that buys a life insurance policy today, most likely in 4 to 5 years, after making premium payments for 5 years, will stop making premium payments and find a new company and go somewhere else because it's $10 cheaper per month.
Yeah.
And so that's all free money that the insurance company made without paying out a death benefit. That's why these companies are so powerful and so successful.
And that's why they sell so much term. That's why everyone buys term, is because you pay it for a set amount of years and then you stop. And the insurance companies they're betting you're not going to have any incident to you in those 20 or 30 years.
Or even the first 5 before you change the policy.
So they know that every dollar you give them is going to be free money, most likely. I think there was another stat. It was like only 2% of life insurance policies last year paid out of all of them. 2%.
This is why they're so powerful.
Yeah.
It's a great business to be in, but since we're trying to leverage the actual policy itself and invest in it as our bank. And so super interesting conversation. Is there anything else you want to share as we wrap up?
No, I feel like we've kind of touched the concept pretty well. Again, I would like to talk to anyone who wants to learn more about this, so we can definitely do that.
Look, infinite banking, it's real, it's different, it's not what you think. Death benefits, the last reason why you get it. The first reason is for banking, for high interest rates, or I'd say higher than the bank typically, tax-free, and using it as your bank account. So anyways, as we always do, let's wrap up this episode with our sweet sour service. So did you think about it this morning on your way in?
No, I should have though. I should have. Let's go service. Last night we went with Anna and I went with another couple to play pickleball, had some dinner, and we bought dinner for them. So that was good service.
All right.
Our sweet, probably. I know. This weekend, we are going to Chicago to go to Week 1 Bears-Packers. We're huge Chicago sports fans.
Can't wait.
So we're pretty excited about that. It's big sweet. No sours. No sours for today.
All right. My sweet is we had a great long weekend this weekend, hanging with the family. So it was really nice and quiet and by the beach. So that was nice. Sour and service, I'll say we're both these things, is last night I was getting all ready for bed, and then Cole got back from football practice at 9 o'clock at night, and he wanted something particular for dinner. He actually wanted Chick-fil-A. It was Monday night, so I drove at 9 o'clock at night while he showered from back practice to go get him Chick-fil-A at the service. Chick-fil-A was closed on Monday this week. Didn't know that, so then I had to go somewhere else to get him food. It was a later night, kind of running around. He didn't want anything here from the house. So anyways, that's my sweet and sour service.
Yeah.
Hopefully you're doing that maybe with your friends or family, and thanks for sharing this episode with us.
Hello, everybody. This is Carson Herlean, co-host of Generational Gains, the podcast, where my dad and I, Greg Herlean, discuss all topics of real estate, banking, finances, and all different money topics from the perspective of me and him. And so I know you're here because you just listened to the podcast or watched the podcast where we talked about the concept of infinite banking, which is an amazing money making, wealth building concept. And we went through the whole concept pretty well in depth, but I feel like we could have gone a little more specific and been a little more informative. So I know my dad also mentioned in the podcast that I'm going to present something after this to talk about some numbers, give you some examples. So I'm going to do that definitely. But to start, I just wanted to say one thing. Infinite banking it's a very simple process. And that's what it is. It's a process more than anything else. A lot of people, and you might even have this opinion after hearing us talk about it, but people think infinite banking is a life insurance policy, or they think it is a investment they're making, or even a payment. And it's none of those things. It really is, I mean, all of those things really into one. It is a process of your cash. It is the flow of your money and where you do that. Everyone makes money. Everyone keeps money somewhere, and everyone pays for expenses. Everyone buys cars. Everyone makes investments. All of these things flow through your bank. Same with me. With infinite banking, we change that. Instead of running all these different investments and debt payoffs and things like that through your bank, you now run it through your policy. And I know we talk about all the reasons why in the video and in the podcast, but I want to give you a real life example of what mathematically this looks like. So I'm going to share my screen real quickly. Alrighty, here we go. So this is an example of someone I actually know, someone's policy. And this person deposits $10,000 a year into his policy. This is the policy premium for him. A lot of people, when you look at life insurance, think premium is a bad thing. Think it's a payment you have, and it's all costs, it's all expenses. Nothing goes to you. And that's normal life insurance, to be honest. Term insurance, a lot of IULs, regular old whole life insurance is like that. And so this policy is something that's completely different. Don't get it confused. You can't go to any regular insurance agent to get something like this. It has to be specifically designed for banking with people who know how to do this. So if you're, this person's example, they're depositing $10,000 a year. We call this a deposit, not a premium payment, but a premium deposit because it is a deposit, right? It is, you have access to the funds. Wherever you put money you have access to, that's a deposit to me, right? It's not a payment. So in this example, he puts in 10 grand a year into his policy. And again, don't get distracted by this number. You can have this number be whatever you want. If you want to put in $1,000 a year into your policy or $1 million a year into your policy, you can. And so don't get hung up by this number. It's just a simple number to work with. So in this scenario, he puts in 10 grand a year. I'm going to show you the first 7 years of this policy just to kind of give you an idea, an example here. So this person has cash value in his policy. Cash value is what you can utilize today. It's what cash you have available to take out of the policy. So in a regular old insurance policy, the cash value would be zero every year. In a regular whole life policy, it would be zero for probably 2 to 3 years, and then it, maybe $1,000, 2,000, and it would slowly grow. But you wouldn't have access to much money for a long time. This policy that I'm showing you right now is an example of someone who had access to 58% of their money immediately to go use. And every single year that increased. The third year of this, it shows you the cash value drops to 4 grand. Don't get distracted. It's not, how it normally is. It's just for the example on the next slide, you'll see why it shows that. But this cash value is what this person can utilize. So I'm going to show you an example of buying a car because that's what we talked about most in the podcast. We're buying a car here. So in the third year of having this policy, his cash value in the first year was $5,800. Cash value grew in the second year, grew to $12,000. Third year, his cash value is $29,000 and 204. Sorry, $29,204. And he took out $25,000 to go buy a car. So his cash value was left with $4,200. Again, this number can be anything you want. I have a friend of mine who just went and bought a $250,000 car doing this exact same thing. So you can play with these numbers, times 10 on everything here. Same kind of idea. That's what he was doing. So you take out $25,000 to go buy this car from your policy, you buy it in cash. And again, we're comparing this model to just normally buying a car. And how would we usually do that? There's a couple ways. One, you would use the money in your bank account to go buy a car cash. 25 grand, go buy the car cash. Or you go finance it. You go get a $25,000 loan from the bank, pay the bank monthly interest and payments and interest, sorry. And at the end of the payment period, you have the car. If you buy the car in cash, you have the car immediately, but you lost 25 grand, right? No cash flow. So in this scenario, it's a way for you to purchase a car and be the bank, be in control, be earning interest while buying the car, and then paying yourself back with interest. So you are treating yourself as if you were buying this from a bank. You are treating this bank, your policy, your bank, as if it was someone else's. You're going to be an honest banker with yourself and pay back yourself interest and principal. So in this scenario, he buys a $25,000 car. And like I just told you, you're going to pay yourself back. So he's going to pay himself back $500 a month. That's what he would have paid the bank. So he's taking a loan from himself for 25 grand. He's going to pay himself back $500 a month for 5 years. At the end of 5 years, he will have contributed $30,000, paying himself back for the car and interest. So this person, after 7 years, he put in 10 grand a year. He totally, his total deposit in here was 70 grand. He also put in 30 grand into the cash value, paying back the car loan. So he totally put in $100,000 into his policy over 7 years. And he went and bought a car. So 100,000 minus 25, 75,000. So net injection into this policy is $75,000. And here's the big piece. After 7 years, you now have $75,000 that's net injection, and you have a car, right, from that. And your total cash value after 7 years is $67,000, 881. So here we go, move to the next slide. 67,000 divided by 75,000 is 91%, 91 cents on the dollar. He got 91 cents on the dollar back for the car he purchased, right? You only put in 75 grand and you have 67 available and you bought a car. So you got 91 cents back on every dollar you spent on this car. Or you can also look at it as you spent 7 grand, 75K minus 67. 67.8. So you spent about 7 grand on this car instead of 25, right? Or you can say I got 91 cents back on the dollar for this car you bought. And we can even take this a step further. So to go further with this, let's keep going. Let's say on the 8th year of this policy, he goes and buys another car for 25 grand. He's done with the old car, ready to get rid of it, wants to get a brand new one, right? We all get a new car after a few years. So in this example, I'm also going to say that I deposit nothing back into this policy. After 7 years, you typically can stop contributing towards a policy. I never recommend doing that. You probably don't want to do it. But for this example, to make it simple, let's just say you do not contribute anything else into the policy after 7 years. So year 8, cash value is what? 51,000 plus 25. He has $76,000 in his cash value to utilize year 8. And he buys a new car, takes 25 grand out, goes and buys a new car, right? Same thing. Let's just say he goes and pays himself back $500 a month for this car, same process. Let's look at it this way now. So after another 5 years, total injection into the policy is 30K minus 25 for the car you bought, $5,000 net injection into this policy after 5 years. You put in 5 grand, and your total cash value is $91,000. After 7 years, it was 67. So it grew by $23,000. Your cash value, I'll tell you again, grew by $23,000 in those 5 years. And you put in how much? And you got what? You bought a car, paid yourself back what you would have paid to someone else, right? And you have $23,000 that you grew inside the policy. You didn't just get 91 cents back on the dollar. You spent 5 and got 23. You more than quadrupled your money and have a car. You got 4 times the dollars back on the car. I'll let this kind of sink in for a second. You bought a car, again, paid yourself back, net injection into the policy is $5,000, and you grew in your policy by $23,000 that year. Or sorry, that period. Over 5 years, 23 grand you grew by, and you got a car. Comparing this again to the normal way of buying a car, you go, you finance the vehicle, or you buy it in cash, you spend 25 grand, that's it. Buy it in cash, your car is there, depreciates, no cash flow, no payment, gone. That's it. Otherwise, you finance it, you pay $500 a month for the car for the loan, and you end up paying $30,000 to someone else. You have a car that depreciates. That's that. In the system, after years of having this policy, because you're earning interest on everything you've put in there while buying the car, you were going to get the car and have 23 grand left over afterwards. After having the car, you have both. You made money and got a car. Right? The longer you do this, the longer you have your policy, the more it grows, the better and better this is going to get. So we can even take this a step further, or a different direction, I guess you could say, and talk about making an investment. So instead of, let's just say in year 8, I don't need a new car. I'm happy with my car. I'm going to go buy a home. Let's go buy a rental property instead. Let's get into the investment space. So I go and buy a property, and I'm going to put in 25 grand into it, right? Let's just say this is a super small home. We can go in Alabama. It's an FHA loan, super small home, right? Whatever. Put in 25 grand to go buy this home. Now your home, your rental, is now cash flowing $500 a month. So great. You're making 6 grand a year. So in this scenario, these numbers different, right? It's not the idea. We're not buying a car. We're not losing any money, but we're buying a home. We're buying a cash flowing asset. So this is actually, instead of a payment, this was new income into your household, new money. So after 5 years of your home, you made $30,000. You made 30 G's. You have the home, you have the asset still that is probably paid down. So you still have the 25K. You made 30 grand, and your policy grew by $23,000 in the cash value. Okay, you made money 1, 2, 3 times. You made money 3 times on this one transaction of buying this home. If you were to just go buy a home, same thing, you would earn once in the appreciation, right? You'd earn twice by the rental income. That's it. You're not earning the extra money because you're using the policy to do it. You're making money in the policy while you are purchasing this home or while you are making the car payments. This can be used for anything in your life. Change this to anything. You invested in stocks. Instead of buying a home, you, I don't know, whatever you like, understand, and are interested in, invest in those things. If you want to build a gym and it's going to create some great income cash flow for you, great. Use your policy, 25 grand, go start a gym. With all the income you earn, throw it back in the policy. You will make money once, twice, 3 times. I don't know if I can stress all this enough. I don't know if all this even made sense. So please let us know what questions you have. And if you are interested to look like, or into looking to, if you're interested to find out more what this would look like for you, let us know. I am very involved with infinite banking. I do a lot of it myself. My dad does. I teach a lot of people how to do this. So if you're interested in being in the real estate space, paying off debts, buying cars, any financial transaction, really, you can utilize this concept. And so I can help you set that up, help you learn how this works, get you in touch with the right people to do it. Because I'm doing it. We know exactly the best places to go do this, the best insurance companies, and the best way to structure these policies. So if you have any questions, reach out to me. You have our contact info on social media, on our podcast streams. So anyway, have a great rest of your guys' day. And it's great thank you for following our channel and supporting us. Have a good night.